Hello everyone. We just wait 5 minutes and let others also join if anyone is late. Okay. So I will unmute again at 7:35. Okay. Meanwhile, if you guys have any questions and doubts from the previous sessions, you can just post them. So when I just paraphrase what we did in the last class, you guys can also pick up from there, refresh, and have some queries also sorted out. Okay, so guys, let's begin. Anyone has any queries from the last class? All clear till everyone? So then if you just write all clear, then I know that you have no queries as of such, right? So, just let's revise what we saw in the last class because it's been a little while, right? So I told you that, we will be keeping focus on five things when we consider any uh, financial analysis with regards to volume. One is with regards to revenue, sorry. So one is the volume, market share, from that we get average realization, right? Third thing. Fourth thing is capacity utilization. In this case it is not there because there is no such capacity constraints, right? And fifth one is size of the market, right? So value, volume, average realization, market share, capacity utilization, and size of the market. These are some of the things that we focus on, right? Now, typically, what happens is that a company will always push market share stabilization the first thing, and so volume will play the key. That till that time, company will not look at price because they want to cover the cost of their operations. So the first thing is to cover your basis, and that is to protect your company from making any losses. So company will put market share at a reasonable margin so as to cover their fixed costs. Once that setup is there, then they will go for market share maximization. Once their market share stabilizes beyond a point where they are not able to grow very easily, then they will start pushing volume to gain market share, and then through a combination of price and volume they will manage growth. Okay, So this is typically how a company works. Okay, if you have a if you have constrained by capacity, you will try to push maximum capacity without looking at price erosion, maintaining price stability. And once you have reached 80-85% utilization, okay, that is when the price hikes come in case of commodities, because the market is getting tight. Okay, so this is how things work. uh, from there we get our revenues. So different streams will have different revenues. When you combine them, we get a revenue from operations. uh, then we look at YOY growth, right? YOY growth. So I've told you guys that growth is managed by the company. Then when you deduct all the direct expenses related to operations, you get the gross margins. Two things to factor in when you look at gross margins is absolute growth in gross profit is always better than gross margins. And second thing is that your gross margins or gross profit per unit should never be lower than average of the industry. So you should always check, and that will give you an idea of whether you are a market leader, whether you're a laggard in the industry, and stuff like that, right? So once we have got the gross margins and gross profit, always remember maximization of gross profit is more important than your average realization and gross margins. Gross margins definitely tells you how efficient your operations are. Okay, you will try to you know improve your efficiency, but at any given point in time, profit growth is far more important than margin expansion. Okay. Then once we are done with the gross profit, we will be deducting all the expenses which are related to the indirect manufacturing, which are, employee costs, other expenses, and stuff that we get. Okay. So when we go forward, you get your EBITDA, right? EBITDA is nothing but the profit that you generated from your operations that you had undertaken, right? And from that, we just in line with the gross profit, we deduct the EBITDA per ton. We also get the margins, and we follow the same rules that EBITDA maximization is more important than EBITDA margin or EBITDA per unit, right? So this takes care of your operating profit till we have studied that, right? Okay. Now uh, we are now getting, so till the EBITDA, every company ka balance sheet, every company ka financial model is going to be starkly different, right? And because every model is starkly different, we have spent a lot of time focusing on that. So whenever you do any company analysis, this part till what we have seen right now is the most important, and this is where further things happen. Now, depreciation and amortization is nothing but expenses related to the capital base of a company. Okay. So when you put up a capital, just 1 second, please. Just 1 second, guys. Okay. So we have to, so what happens is that the capital base or the assets of the company have to be kind of provided for. Okay. So, you are creating a sinking fund for replacement of those assets. And what do you do? The life of the asset which is there, now it keeps eroding. So, just like human cycle, beyond 30 years of age, your efficiency diminishes. When you hit 50, it starts diminishing a little more. When you hit 70s, you rapidly deteriorate, and then, you are no more, right? So just like you have a lifespan, and your efficiency and your operation capability deteriorates, in the same way every physical thing that is man-made has a lifespan. So when we talk of lifespans, we are referring to the life of a building. So let us say the life of a building is 50 years, the life of a car is 10 to 15 years, your the life of your mobile phone might be 1.5 years or 2 years, the life of your computer machinery might be 3 years, 3.5 years, right? So what needs to be done is, you need to provide for these replacement. These products need to be replaced. So for a building which has a very long lifespan, the tenure of depreciation may be very high. It is defined in the Income Tax Act and the Companies Act, and we follow all those norms, right? And along with that, we also have norms for uh, intangibles. Okay, so when we talk of intangibles, what do we mean? Software, patents, they also need to be provided for. So we what the law provides is that you take a hit on your profit and loss account. Now this is a fictitious transaction, it does not involve any payout of money. So depreciation and amortization is a cost which is fictitious. So you deduct from your profit and loss account. Okay, you mark down your profit and loss account to that extent, and at the same time you deduct the value of your asset also. So artificially on your books you're reducing your value of the asset, and the value with which you are reducing your asset is deducted from the profit and loss account. So what happens is cash is not actually flowing out of the business. Okay, cash is retained within the business, but this is a entry which is provided for replacement of that asset, or you can call it as a sinking fund. Okay, so when the asset is completely worn out, you have created a contingency over a period of time, and you can replace it. Also, another way of looking at it is the fact that the value of your assets, okay, are never the same. So you have to always mark your assets based on the life of the asset, right? So to that extent, the depreciation is provided so that your balance sheet at any given point in time reflects the realistic value, the realizable value of your business. So if you were to wind up the business and sell it out, what would be the realizable value of your business? So depreciation and amortization takes care of that. Okay, so based on different principles we deduct that. Okay, uh, just to give you a brief breakup, what depreciation is calculated on gross block. When we do that, we will look at it when we go to the balance sheet. So here what we do now, if you'll notice that because you have a multiple of assets, you will find that the depreciation rates are different. Okay, so we will generally get depreciation to gross block, and sometimes companies also consider depreciation as a percentage of sales. Okay, this is typically what is followed: depreciation to sales. Okay, on a percentage basis. So if you were to calculate that, this would be depreciation divided by your net sales. Okay, so if we were to, right, so you can see that it is 3.8% of sales. And if I were to drag this to the right, you will see that the depreciation was more or less 4% of sales, but somewhere in FY15 it right really picked up 6.7, 6.5, right? And in FY20 it was close to 8.3, 8.6 in FY21, and I can just fill it out here, right? So you're seeing that. So what you'll notice is that they have done higher depreciation to sales. Okay, and the reason for the higher depreciation to sales is that one, their capex has gone up, and two, their revenues have come down or remained static, right? To a certain extent. Sorry, revenues are out here. So you can see the revenues have remained relatively flat. So, this year the depreciation has gone up, right? So if you see 6612 in FY18, 6900 and 6500 in FY20, and you are at 6421. So, the company has been continuously investing and seeking depreciation, and because the sales have remained flat, the depreciation value has gone up. Okay, so this is what we saw out here, depreciation to sales. Whereas on the depreciation to gross block, we have remained more or less static at about 6.6 as of last year, right? So once you provide for this expense, now you get something which is known as earnings before interest and taxation. So remember one thing, that once you have created an operating profit, there are three people who have got first recourse to your business. One is you're providing for your depreciation, then you get earnings before interest and taxation, then the banker comes and takes his fair share. So based on uh, the capital that you have, the financial costs that are involved, there would be a deduction on that. So the interest element is taken care of based on how much loans you have taken, working capital that you have taken. Then after that comes a taxman's share, and once the taxman has taken his share, then you get the net profit which is available to you. Then this net profit is distributed to shareholders as dividends, and whatever remains after that gets added to the balance sheet as accumulated reserves. Okay, so this is the typical procedure that we follow. So from EBIT, you will find a EBIT margins. Again, we look at EBIT margins in line with EBITDA. Now, for companies which have got very low depreciation or low fixed asset formation, for those companies now we look at EBITDA, EBITDA margins. But for companies where the capex is very low, for example, IT companies, platform companies, etc., there we will look at EBIT as operating margins because the depreciation element is very small. Okay. Once you have taken the EBIT and EBIT margins into perspective, you know, spare cash is actually spare cash is parked into some assets in the company. So those are the other income that we add to the business, and we subtract the finance cost, right? Once those other income and finance costs are subtracted, then there would be exceptions for doubtful incentives that you reached, you know, provisions that are written back, and and any provisions for interest payable, all those are deducted, and then what you get is the profit before tax. Okay. Now this profit before tax you can calculate per ton also on margin, because we always do that with, as you have seen here, all the profit figures, the operating profit, the operating EBITDA, the profit before tax are all calculated. And then we have to pay certain taxation. This tax element now I will explain to you in greater detail in the next class, because it needs to be understood in terms of current tax, deferred tax, and various elements. So there are some elements which we are going to study later, which are uh, additions to the this thing. So we'll be discussing MAT, deferred tax. We will be looking at current taxation. We will also be looking at another function called right to use and minority interest. So suffice to know that for the time being that we pay tax, and there's a combination of all this, and the total tax paid is about deducted from here, and from that you get PAT, right? Then you get the PAT margins. From PAT margins, then we deduct minority interest or share of associate. So I will explain this very nicely in the next class. Okay. Right now, first let's go through the entire process of the balance sheet, the P&L and cash flow, and then we'll come back to these slightly advanced topics. Okay, so you get the net profit. Now from the net profit, you can obviously calculate the EPS. So the EPS divided by the total number of shares. EPS is obtained by deducting the net profit from the total number of shares, and this EPS is the earning per share, so or profit per share you may consider. Then obviously the dividend payout ratio is nothing but the rate at the amount of dividend paid. So this is the equity dividend paid based on the dividend uh, percentage that the shareholders meet would have calculated. And when you divide by the dividend paid by the net profit, you will get the dividend payout ratio, right? So typically you will see that the dividend payout ratio here is about 19%. Uh, Out here it's 35%. In FY20 it was 139%. They paid a special dividend to the government. And next year it was 487%, 84% dividend payout ratio. Now you have to understand that the operating net profit that a company earns essentially has three uses. One is to pay dividend, then second is to provide for future capital formation which you might need to expand your business, acquire a business, okay, cash for emergency purposes, and the fourth function is to add to your reserves, right? So generally these are the applications of the dividend. So the dividend payout ratio is typically a policy decision what the government says. For example, Infosys says that all the free cash flow generated we will distribute. Okay, so they either may distribute in the form of a dividend or they might distribute in the form of a buyback, right? So these are some of the ways that equity dividend is calculated, and this is the point at which the profit and loss account and the uh, balance sheet get linked. So what happens is that any addition from the net profit gets added out here to the gets added out here. Okay, so that is how it flows. So any questions up till now on the profit and loss account? You may shoot now because that is what I will uh, attend to. Any questions so far on this? Okay. Agam is asking for a multi-bagger stock. Is high dividend payout ratio desirable? So Agam, it depends upon how much cash flow is being generated and what is the need of the business. Okay. A, a for a multi-bagger stock, see valuation of a stock is a function of three things. One is your growth rates, obviously, in revenue and earnings growth. Okay, the higher the earnings growth, the investment of a shareholder is paid back faster, so you get a higher P. Second is that if you are generating a large amount of cash, okay, then if you retain it on your books, what will happen is that your return ratios will come down. So for example, if your operating profit margin is 30% and the cash on your books is generating to you only 5-6% return, okay, that cash will bloat up your capital employed. And when your capital employed gets bloated up, your RO, return on invested on your equity, return on equity or return on capital will come down, right? So when these returns come down, what happens is that there is inefficient use of capital, and hence the return of capital, because you have so much cash on your books, gets delayed and your P multiple will suffer. Okay, so companies always do a judicious mix of how much capital is required for the future. If you don't require higher capital for growth, or let us say if you do not have optimum utilization of capital to sustain the return ratios on your capital, then what will happen is that the company will return the cash to shareholders so that the cash is gotten out of the business. Secondly, higher dividend shows the earning capability, shows you the free cash flows that are being generated. Okay, so a higher dividend payout ratio is a double-edged thing. If you're a growth company with higher dividend payout ratios, then you can be very sure that the management is extremely confident uh, of sustaining the growth rates, and they don't desire the cash, or their internal cash generation is very high. So it's a combination of these three things. You have to understand what is the growth rate. So for a company like Infosys, growth rate is very less, but cash flow generation is huge. Now, if they sustain the cash on their books, what will happen? The cash balance will increase, and if the cash balance increases, what will happen? ROCE or ROIC will come down, and because of inefficient allocation of cash, the multiples will come down. So they use that higher cash flow generation to buy back stock, which reduces your equity, right, and improves your EPS. It boosts your share price, and at the same time improves your or sustains your return ratios. So return ratios are a very important function of a business. Okay, they are grossly underrated. Newcomers in the markets pay a lot of attention to EPS and EPS growth, but EPS and EPS growth should also be seen in relation to return ratios. We will be studying that in detail as we go ahead, right? So, any other questions that you have as of this point in time? Okay, second doubt with respect to interest cost versus dividend. If a company is having a high debt and also pays the dividend, wouldn't it be efficient if the company repays out the outstanding debt and then pay off the dividend to the shareholders? Yes, but you know what? If you have high interest payments as well as dividend payouts, then it is also giving you a signal that the management is fairly confident of managing their uh, growth rates. It sends a very positive signal to the market that you know uh, the management thinks that the business is very solid and that the debt payments can be catered to even if they pay dividend. So they have extreme confidence in the cash flow generation of the business and the business model. Okay. So if you see IOCL, okay, IOCL has got very high interest payment because it's a very cash incentive business. How does extra cash on balance sheet reduce ROE, ROC? So as I told you, if you have extra cash on your balance sheet, your capital employed goes up, na? Capital employed is the sum of everything on the asset side or on the liability side, right? Now, when you reduce the cash by paying out dividends, you are reducing the capital employed. And when you reduce the capital employed, the denominator which is used in the calculation of ROC and ROIC also goes down, right? So, to that much extent, your return ratios get amplified, right? It's a mathematical thing, yeah, to understand that. Sir, but it can also be inferred that the company is borrowing money just to pay the dividend. So that you need to see based on the working capital, right? If it's a very high working capital intensive business, so if you see the IOCL ka, if you see the IOCL ka balance sheet, right? IOCL deals in oil and the oil prices fluctuate up and down, right? They also have to give subsidies to certain classes of consumers, and those subsidies may not come back in time to them, and then they get bonds from the government, and these bonds they have to discount in the market, so their working capital goes up, right? So when their working capital goes up, it is guaranteed by the government of India. So it is there is no problem with the receivables there, right? And when you do not have any problem with the receivables, what happens? You can afford to take debt. Majority of that debt is going to finance the working capital, and you can then give dividend. So that's the way it works. So, as I told you, it's a double-edged sword, and you need to analyze the business model also. If you think that the business model is defunct, cash flows are not positive, and still the government and still the company is giving dividends, then they are borrowing to pay Paul, right? So they're artificially managing their trying to boost market sentiment. So while you're right on that aspect, but everything need not be looked at negatively. It also depends on the intent of the promoters and the cash flow generation of the business, right? So that's that. Any other questions? So then we'll move towards the balance sheet as for portion. Yeah, shall we move ahead? Yeah. Okay. So once you have seen the balance sheet, you know you are aware that money is put into different capital heads. They have different types of heads: general reserves, retained earnings, other reserves. These are all self-explanatory, and uh, I will be circulating a note to talk about them. So once you take the total shareholders funds, that is the retained earnings after paying taxes, dividends, and doing buyback, whatever funds remain get added to the share capital and total reserves, and you get the shareholders funds. And when you divide this by the number of shares, you get the book value per share, right? And when you divide the net profit by the shareholders funds, you get the return on equity. This is what the investor is earning as a return on equity. Now this return ratio, okay, should always be should always be higher than the cost of capital. Okay, because if you earn less than the cost of capital, that means what? You are value destroying. So when a company is earning 4, 7, and 5%, and if your cost of capital, which is a function of the your share price movement as well as the cost at which you borrow funds, okay, will indicate that you're destroying shareholder value. And you as an investor should have a threshold of return that you want, na? So if you're looking for your portfolio to earn you say uh, 15%, and if this stock is giving you a return on equity which is less than 10-12%, then what it shows that it is not justifying your investment. So if your cost of capital is 15% and your return on equity is 10%, that means you're destroying shareholder value, right? Now, non-controlling interest is that part which I told you about, share of associates or minority interest, which are deducted from your uh, shareholders funds. Okay, so the non-controlling interest is accumulated out here. Okay, we will be discussing all that in detail. Now you have different. So if you look at a balance sheet, it typically has two sides to it, right? You have the liability side and you have the asset side. Okay, the liability side of a balance sheet essentially tells you what the company owes other people. So what the company owes other people is the shareholders are the owners of the company who ultimately need to be paid back. Okay, that is why it's a liability for the company. Then whatever long-term funds that you borrow na, is part of long-term this thing, long-term liabilities, or what we call as non-current liabilities. And then, so these are your total non-current liability. I'll come to that in detail. And then whatever are the short term liabilities which are less than 1 year and all. Na? They will they will formulate a total current liability. So the differentiating word out here is current and non-current. Current means those which are to be paid in less than a year, and non-current are which are going beyond a year. Okay. So what are the elements of the non-current liabilities? You might have long-term borrowings, term loans that you've taken. Okay. Other long-term financial liabilities could be security, deposit, lease liability, and other provisionings. Okay. So this will give you your total long-term provisions. Then you have certain deferred tax liabilities which you have to pay over a period of time. Currently here they are zero. Okay. And other non-current liabilities could be deferred government grants, lease equalization reserve, provisions for deferred income. Any income that is coming, and we are providing for that would come here. Okay. So this becomes your total non-current liabilities. Okay. All these deferred income terms and all that, and this lease liability reserve and all, we will be seeing in greater detail, as I told you earlier, once we get the entire hang of the complete balance sheet and all through after today's part. Okay. So you got a total non-current liabilities. So your short-term things work out to be short-term borrowing, which are working capital, right? Now, working capital typically has three components. Okay, you carry inventory on your books, you carry, you owe money to people because you get credit from your vendors, and you give credit terms to your consumers also, which are called debtor days. So you have inventory days, debtor days, and you have trade payables, okay, or creditor days. So these are the things, and typically they are calculated in payable days format. So what do I mean by payable days? Your working capital is typically seen in the number of days it requires, and basically what you do, your total trade payables divided by your working capital into 365 will tell you what is your payable days. Okay, so this is your debtors into 365. Look at this formula out here. So debtors into 365 divided by net sales will give you your trade payables. Likewise, your inventory days are calculated, and likewise your debtor days are calculated. So you'll find that the company has got a a tendency to pay at a later date. So earlier they were paying in 12, 13 days. Now suddenly they've gone up to 23 in FY17. That was due to the demon. Then 15 days. Now they're in 19 days in FY21, and FY20 they were down to 9, but in FY21 they're at 15 days. Okay, so this is how it is. So when you forecast now, you should always forecast for paying earlier and receiving money later, whatever may be status quo. So what you're doing, you're building in conservativeness in your forecast methods that we do. And the other short-term financial liabilities that you consider are employee-related dues, you know, and current maturities of long-term liability. So, long-term liability which becomes payable within a year will become classified as short-term. Then there will be short-term lease liabilities and some other liabilities which are there. And then your current liabilities and all these various formats of advances, deposits from customers, statutory dues, etc., will all contribute to your total current liabilities. So this is what we have seen on the liability side of a business. From our analysis point of view, the liability side of a business is very, very important because ultimately everything flows to the shareholders, right? So this is what the shareholders have invested in your business, and this is the reserve that is there in the name, and this is what you owe your shareholders, right? Secondly, then this is what you owe your the guys who borrow you the money, the long term liabilities, and finally this is what you need for running your business, right? The current liabilities, all this, and the total of all these things now will give you, so total of the entire thing is known as capital employed. Okay, and when you divide the EBITDA by the capital employed, you will get what is known as the return on capital employed. Okay. And when you calculate the return on invested capital, which is nothing but the capital employed less the cash on the books. So, from the capital employed, uh, you deduct the cash on the books, you will get in return on invested capital. Okay. So this is what I was telling you about total liabilities. Okay. So it gives you the total liabilities that are there, right? So total liabilities is nothing but the sum total of the total current liabilities, the total non-current liabilities, as well as the shareholders' interest. Okay. And the differential between capital employed and total of the liabilities is out here. So if you see, it is D153 plus D111. So your D153 is total debt, okay, and D111 uh, is your shareholders funds. So total debt and the total shareholders funds will tell you what is the capital employed. Okay, so you'll get return on capital employed. And when you're calculating invested capital, D154 plus your D111. So in capital employed, you are taken total debt. Okay, and in invested capital, you're taking total net debt. So what is net debt? It is nothing but the total debt minus the cash on the books. Okay, we will come to that a little later, but you try to absorb these formulas out here, what we are discussing. Okay, now we will undertake an analysis of return on capital employed and return on invested capital. So there are three terms that we use. Okay, return on equity, uh, return on capital employed, and return on invested capital. You can use all these three terms interchangingly. Okay, so if you have got a very high debt business, okay, you will use a return on capital employed principle. If you have a company which is a high growth business, has got high debt and has got high cash on books, then you can use a return on invested capital funda. If you're referring to a company where it is difficult to calculate capital employed, for example, if you're taking a bank, how do you differentiate between liability where equity, where debt is actually a form of input cost, right? So there we use return on equity. Okay. And as a proxy to that, you can use return on assets. So we'll come to the asset size later. But what I wanted to point out to you is a very important thing is this part where we talk of total debt, net debt, net debt to EBITDA. Okay, let's bold this for our understanding. Okay, and just so we will talk about these four things right now. So you are obviously aware that we use total debt as a measure of what the company has borrowed. So it is a function of long-term liabilities, short-term loans, as well as working capital that the company has raised. Okay. Now, typically, what happens is, you know, uh, bankers, in his classical financial analysis, you always consider net debt to equity. Okay. Second thing, how is this net debt equity derived by? This is derived by the number of cash on the books. Now, here you will find that the net debt is turning negative because the company has got significantly higher cash on the books than the total debt that it has. Okay, very simply put. Now, here you will find in FY19 that the net debt went up. Okay, so while it was a cash rich company out here, it turned net debt positive. Okay, so the total debt was 770 crores and they had this less this as the total cash that they had on their books. Now we typically calculate net debt to equity, and we are taught in financial analysis that it should be less than one. Okay, but if you've noticed in the last few years, now there's a aversion to debt, and companies pay back debt very fast because investors like companies which are debt free. Okay, or close to being debt free, or as much debt free as that they can get. But as a banker or a credit analyst, na, you are concerned more with net debt to EBITDA. I'll tell you why. Because as a banker, you are interested, your, as I told you earlier, that as a banker, if you see, if you go to the Ebitda, do you remember I told you that as a banker, you have first charge on the assets? So there are three counterparties. One is the banker, then the taxman, and then the shareholder. So the banker has a first charge on the assets, and so he takes his pound of flesh, that is the interest. So for a banker, more than your net profit, your EBITDA is very important. How much EBITDA you are generating? Okay, and from a banker's viewpoint, and even as a shareholder and investor, you should see to it that the net debt to EBITDA of a company never exceeds 3.5. So I'll give you this by 3.5, and uh, the number, where does this number 3.5 originate from? So typically business cycles are around 3 years. So you have 3 years of up and 2 years of decline, and then you have another 3 years of up and 2 years of decline. So that 3 years could become 2 years, it could become 3 years, the boom period. So if your net debt to EBITDA is more than 3 years, what it means is that when you go into that post that 3 year period, if your debt is more than your EBITDA that you're generating, then you're not able to pay back your net debt over the next business cycle, right? And hence, if any company exceeds 3.5 na, and 4, so 3.5 is a warning number, 4 is a no no. Okay. So this is not there in any classical literature, you'll never find it, but it is a rule of thumb that credit analysts will typically use. So this is something which is not taught anywhere else, and you can use that as a thumb rule, that net debt to EBITDA should not exceed 3.5. Okay. So if a company is at 3 times net debt to EBITDA, you should focus the numbers carefully to see it's not expanding. And if the net debt to EBITDA is more than 3.5, you can safely filter out these companies as a no go area. Okay. Alternatively, if you are in the ARC business or asset reconstruction business, you will take companies with the lowest net debt to EBITDA as your filter criteria for buying junk issues. Okay. So far, we have looked at the EBITDA side, we have discussed the working of the balance sheet, and we have also spoken about all the various elements. Now, in a annual report, you will always find schedules uh, behind the assets and liabilities. So these schedules have been captured out here. Okay. So we have tried to get as detailed data available as much as possible. So here you'll notice that we have input only data from FY19 because this data has to be keyed in physically. Okay, so we have not keyed that in. But wherever required, just for an explanation, I've got it keyed in so that I can give you these uh, suggestions. So we have looked at the total liability side, and if I were to just rephrase for 2 minutes what we spoke about, the profit that was available after distribution to shareholders gets added to the total reserves, and the equity capital plus total reserves will give you the shareholders funds. Now one thing here I missed out to tell you is, notice that 195 share capital became 243. So this is because the share capital increased here, and the share capital can increase if the company issues a bonus or does a fresh issue. Okay. So this is one thing that I wanted to point out. Secondly, the premium that you raise from a fresh issue will get added to the total reserves, not as a part of share capital. Okay. So this is how you get your shareholders funds. When you divide shareholders fund by the total number of shares, okay, you will get the book value per share. Okay, typically if the current price is less than the book value, then these stocks are considered as value investing propositions. So deeper the discount of the market price from the book value will tell you that the business is absolutely undervalued, because if you sell the business and you realize the value, will get substantially higher value. So it's an undervalued business, and for value investing principles, this is one of the tools that is employed. Okay, then we spoke about return on equity. So the return on equity should always be greater than a threshold. Your threshold could be 10%, 12%, or weighted average cost of capital, whatever it is. We discussed the various long term borrowings and different portions of the non current liability side. Okay. We discussed how the working capital is calculated, the short term and the other current deposit, and what elements go into that. So that gives you the total current liabilities. Then we discuss this very important constituent of analyzing the debt, and using the net debt to EBITDA as a key factor in filtering stocks. So anything above 3.5 is a no-no. Okay. And then we discuss return on capital employed and return on invested capital can be used in alteration with return on equity to decide how efficient the overall money is deployed in the business to generate a return, or how fast the company returning the money back to the shareholders. Right? So these were the things we discussed. Secondly, the most important thing is a liability side of a balance sheet more than the P&L and more than the asset side. So you should pay a lot of focus on the liability side of a balance sheet. So far, any questions with regards to this? Please shoot your questions, and then we will move ahead from here. If you guys don't have any questions, then just say all clear, and then we will move on to the asset side of the balance sheet. So Agam, John, uh, Rishi, Shivang, Aditi, Radha, Rajiv, any questions on this? How does ESOP affect the share capital or liability side? So ESOPs are purely provisions made, right? And when the ESOPs are exercised, the liability side will go up because that many shares are issued, but that much premium will also come into the company. Na? So let us say that I issue an ESOP at 65 bucks, and the paid up capital is 1 rupee, and I've issued you 1 lakh ESOPs, right? So when you exercise your ESOPs, uh, the equity capital will go up, right? So that is how it impacts the business. Okay, great. Uh, Good questions, John. And generally, I'm very happy with the interaction that we have. Does it mean there is share dilution? Of course, equity will go up. Now, I'm giving you a share of the business in the future, right? It's similar to giving warrants to a promoter. You give a warrant, let us say the share price is 100 bucks, and the promoter pays you 12 rupees per warrant for buying the shares at 160 bucks in 5 years down the line, right? So that 160 rupees is the warrant fee that you got, right? It gets added to the capital. And then when you exercise the share capital at 160 rupees, you're getting 160 rupees into the company, of which 100 rupees, of which 10 rupees of the paid up capital will get added to the this thing, and 160 will be added to the premium. So till it is exercised, where is the provision made on the balance sheet? So these are complicated issues which we will not discuss right now. Okay. As I told you, in the next class, when we are talking about it, we will take it up. So how does a corporate action like splits, rights, bonus likely to change analysis of the company and its financial analysis? So let me tell you one thing. The split, right, and bonus has actually got no impact on the balance sheet of a company. Okay, all it does is it reduces the denomination. So it's like you have a 100 rupee note, and then I give you 101 rupee notes. What happens to you? So I did a stock split of converting 100 rupees into a 1 rupee share, right? Now, when I give a bonus issue, what do? I increase the capital of the company, right? When I increase the capital of a company, what happens is that the number of shares goes up. To that extent, the share capital reduces. Now, historically, what used to happen? Bonus was considered to be a very important aspect of investor confidence. So when you actually double the number of shares, your earning per share will come down, right? So if you're earning 100 rupees today and I give 1:1 bonus, so and let us say your EPS was 50. So today your EPS will become 25, right? But the share will also half. But the fact that the company was giving bonus was a historical concept where people thought that when a company gives bonus night, it is inspiring confidence in the business of the company, that you're diluting the EPS and still expecting growth. Okay. But when you're looking at shareholder returns and net worth and all those things, the concept of bonus has become redundant. So a split will did you make the share cheaper for some people to buy. Okay. That's the only way it impacts, right? Just try buying a Berkshire Hathaway share which costs 4 lakh dollars. Can you buy it? Not everyone can buy it, na. But if Berkshire Hathaway splits the share 1 by 10 into by 100 times, right? Then the share would be worth $4,000 and some people can still buy it, right? So you're increasing participation and liquidity in the market by giving a split. By giving a bonus, you're also increasing liquidity in the market because the number of shares has doubled. By issuing a rights, what you are doing is you're rewarding your current shareholders. So you're making a rights issue is typically an offer for sale only to existing shareholders. So that is how a rights issue is done, and it is then done at a discount to entice shareholders. But this is now very rarely taken up, right? Promoters all want money at full premium, they'd rather go at a premium, right? So that is how it goes. So if you see today, startups are all doing new rounds of funding at higher valuations, right? So a rights issue is a round of funding at a value which is a discount to the market, or at value to the market. Or if you feel that your business is doing superior and you want to reward your shareholders and make it exclusive to them, so you might even charge a premium, but that is a rare exceptional case. Okay. So that is how all these things are taken up. John, that issue of provisioning for ESOPs and all, it's a slightly complicated concept. We will study at a later date. Okay, suffice for that. Otherwise, it will become itself an issue where we are talking about it, right? Having seen this, let's move to the asset side. So, any questions as of now about the balance sheet? Any other questions? I think most of you are all clear. So then let's move on, right? Uh, so from the gross, so here so let's see the asset side. So the liability is what the business owes other people. Asset side is what the business owns, right? So where the liabilities of the business have been deployed. So when you talk of gross block, we are looking at the fixed block formation. So, under gross block, you have various types of assets that a company owns: freehold, leasehold, building, plant and machinery, furniture, office equipment, others. And the depreciation on the various assets is all accumulated together. So every year the depreciation gets added, right? And then you have accumulated depreciation. And then when you deduct that, you get the net block. Now, what is very important from this is the fixed asset turnover ratio. So, how is the fixed asset turnover ratio calculated? If you see, it is L24 divided by 184. So in this case, 184 is a net block. And if you go to L24, L24 is nothing but your revenue from operations, right? So you're seeing how much revenue are you generating per unit of the fixed asset. Okay. So it tells you the higher the ratio, okay. So the higher the ratio, you are understanding the utilization of your assets. Just like you have plant utilization rate, capacity utilization, right, which tells you how much your plant is being utilized in terms of this thing. How much capacity is available to you. This ratio of the fixed asset turnover ratio actually tells you how better your assets are being utilized. So if you are generating a higher turnover from the same amount of assets, obviously it is a it is a good sign, right? You're generating better returns for your assets that are employed. Capital work in progress is nothing but the uh, capital formation when you're building a building. Let us say it's taking 3 years. So till it is made into a complete usable asset, now it is carried in capital work in progress. Okay. Other intangible assets you are aware of: terminal rights, computer software, right? So that is where it comes. Okay. So this is the part of your fixed assets, your other intangible assets. Then we come to your then we come to the other element, which is your total non-current assets. So just like you had total non-current liabilities and current liabilities, like that you have non-current assets and current assets. So in non-current assets, you will have all these elements which are there, which are any loans and advances given, or security deposit that you have given, or you have advances recoverable, bank fixed deposits, interest accrued on fixed deposits, deferred tax assets. All these elements typically will form your non-current assets. And then your inventories and trade receivables, cash balance, bank balance, and other assets in which are listed out here typically form your total current assets, right? Current ratio is nothing but the total liabilities minus total assets, which will give you your current ratio. Quick ratio is just absolute cash, which are recoverable. Then your net working capital days are nothing but trade payables minus inventory days minus debtor days. Okay. And net working capital divided by the total sales will tell you for how what is your it's another way of recording your net working capital days. So if you see out here it is negative. So what it means is that the company is relying on other people's money. If you see all the uh, FMCG companies which are of international repute, they all have negative working capital days. So their creditor days are more than their payable days are more than the creditor days. So they have to pay later and they receive money quicker, right? So they use other people's money to, uh, you know, get their working capital, and hence these businesses have very high return on invested capital and other such ratios. Okay, so that is what it is about total assets that we are talking about, right? Uh, any questions on this? I just rushed through this part because uh, I don't think you guys have issues with all these things. So this is what I had to take up with you guys. So far, any issues on your on the asset side of the balance sheet? Any questions? So if it's all clear, then can we move ahead with the analysis of the cash flow, right? So we'll get ahead with the cash flow analysis. Okay. So just like you had the P&L which showed you the daily operations of the company, and the balance sheet which showed you what you own and what you owe, you know, The cash flow is nothing but a mix of the financial statement, profit and loss account, and the balance sheet mixed together. And it is done in a such a way where we talk of direction of the flow of funds. Okay. So we consider cash inflow and cash outflow. Okay. Very simply put. And just like, so a business has got three formats we can think of. So, you have operations, then you have investments in the business, and you have financing for the investments, right? So we typically analyze the business from the point of view of cash flow from operations, cash flow from investments, and then cash flow from financing activities. Okay, so this tells you how well your finances are being moved, where it is going, how it is coming, etc. So you know what, we have to restate the balance sheet to a certain extent. So what we do now, as a principle, we start off with the profit before tax. Okay. So why do we start off with the profit before tax? So we are now working in the reverse direction to arrive at the profit from operations or the cash flow from operations. And the cash flow from operations is a proxy for operating profit, okay, but in hard cash currency terms. So what we do, we take the profit before tax, and what we do, so normally what you would have taken your profit after tax, and the first outflow which was there was the tax paid, right? So uh, you would have deducted that to come to profit before tax and all. So what we do, we start with the profit before tax, and we add back the depreciation and finance cost. So why we add back the depreciation? We add back the depreciation because it is a fictitious entry. As I told you earlier, it does not involve actual cash outflow. And why do we add back the finance cost? We add back the finance cost because it is a expense or a cash outflow for financing activities and not from operations. Okay, so we add it back. And for any changes in other assets and liabilities, we follow a very simple rule. Okay, what we say, for assets, previous year minus current year. Okay, and for liabilities, current year minus previous year. So whenever you have any other assets and liabilities which are short term, this is how you utilize it. So you will get changes in working capital out here. So once we've got changes in working capital, we'll add the change in inventory, we'll add change in receivables, and we will reduce the trade payables, right? So you'll get the cash flow after working capital. And once you've got the cash flow after the working capital, now the tax paid is deducted. So this will give you entirely what is the cash flow that you got from your operations. Okay. So if you notice that this is the cash flow that is coming into the company purely from the operations part, because tax is paid from the operations. Okay. So far, so good. Everyone clear on this before I proceed ahead? All clear? So we move ahead, right? Now see, when you're doing this cash flow analysis, this cash flow from operations to EBITDA is a very important ratio that you analyze. Not many people teach this, okay? So why is cash flow to EBITDA important? It actually tells you how much cash you are generating. So EBITDA is your operating profit, that is the accounting entry that you're booking, right? Now you have made certain investments, you have put money, and you're based on your investment, you are getting a return. Now if this return in cash format is going to be as close to the EBITDA or higher than that, is an amazing business to have. So one of the important differentiators of a good business and a bad business is a business that is generating sufficient cash. And how do you understand a business that is sufficient cash? If its cash flow from operations is very close to its operating profit. Okay. Other ratios that we calculate are FCFF and FCFE. We will discuss this when we are studying the valuation metrics. Okay. So once we have seen the cash flow from operations, okay, next we go to understand where the money is being invested. Okay. So investments will obviously be purchase of fixed assets. So any purchases are subtracted, any sale of assets is added back, so you get net capital investments. And if there are any changes in investments, plus or minus is the asset side, right? So it will be current year minus previous year, simply to, on a mathematical basis, previous year minus current year, sorry. And that will tell you how the assets have been flowing. So you get cash flow from investing. And how are you going to fund this, right? So now you are going to fund it from proceeds of issue of equity. There is no issue of equity. Is there any long-term changes in borrowing? So, if you see the liability side says current year minus previous year. So your liabilities have come down, right? Your short-term borrowings have gone up. Okay, then you deduct the expenses paid. Okay, then you deduct the dividend paid, then you deduct the distribution tax paid, then you add the share of non-controlling interest in subsidies, and if there is any changes in other long-term liabilities, okay, other liabilities from the long-term period. So in the forecasted period, we cannot get these numbers very easily, so we tend to keep it at zero or at the same levels. So finally you get cash flow from operations, and when you deduct this from the cash flow from operations, less cash flow from investing, less cash flow from financing, you will get net cash flow. And when you add this net cash flow to the opening balance sheet, okay, this number is the number which is reported in the liability side of the balance sheet. Okay, so this is how all the three of them tie up together, right? So as I told you that, understanding how it is, if you were to rephrase all the three things, is that when you're doing the analysis of the profit and loss account, five things you need to do when you're looking at revenue: understand value, volume, value, average realization, market share, capacity utilization, growth of the market, right? Then when you come to, once you have seen the revenue, you will come and check how the gross profit margins are doing. Gross profit is more important. Gross profit growth is more important than the margins. Margins indicate efficiency. Okay. If you are dealing in a commodity business, you would also look at the EBIT, gross profit per ton. Same thing for operating profit. Same thing for EBIT and other things, right? Once you have done all that, you will see what is your profit margin coming to you, net profit margin. The net profit margin, afterwards you will get the earning per share. Now when you divide the CMP by the earning per share, you will get the P ratio. When you compare P ratio, when we do valuations, we look at that. Then you look at the dividend paid. Now the dividend payout ratio is more important than any other thing. The dividend payout ratio establishes confidence in the management. Higher the dividend payout ratio as a policy, better, right? Then we discuss shareholder funds. We discussed adjusted book value. If the current market price is at a discount to adjusted book value, what does it indicate? That it's a value business. And then you will look at it from the potential for future growth, and value investing principles apply here. Okay, return on equity is telling you how much the business is returning to the shareholders. It should be greater than a hurdle rate. Hurdle rate can be cost of capital, weighted average cost of capital, or a hurdle rate that you decide for your investments, right? So if you say 12% investment rate, this business will not qualify because the last 2 3 years it is earning less than the required 12%. Uh, then when we do the analysis of the debt, as I told you, net debt to EBITDA is a more dynamic number than net debt to equity. I've explained to you all the concepts. Then we looked at return on capital employed and return on investment capital as good proxies to use for analyzing return ratios, right? After that, we saw the fixed asset return ratio telling you how efficiently your assets are being used. Then we saw net working capital, and net working capital, the negative the number of days, the better the business is managed. Okay. Then once we went to the cash flows, what we understood is that a cash flow from operations, if it is as close to EBITDA, it is a better thing. Okay, because it tells you that the business is generating cash, because cash is king, and it's not just an accounting entry, and not continuously investing to get higher growth, right? uh, After that, we saw how the cash flow numbers tie up into the balance sheet of the annual report. So this is the sum and gist of the entire financial accounting that we do. And from the next class onwards, we have done ratio analysis also. All the relevant ratios we have looked at. We have done cash flow, we have done balance sheet, we have looked at the P&L. And further ahead, we will be looking at subtle nuances of the balance sheet. There are 4 or 5 terminologies which we'll be looking at. So we will be checking out uh, right of use. We will be looking at deferred tax, marginal tax, uh, different forms of taxation. We'll be analyzing share of associated minority. We'll be looking at subsidiaries, fully owned subsidiary, partially owned subsidiary, how to account for them. We will also be doing analysis of, as John had pointed out, how the treatment of uh, ESOPs is done and stuff. And I will be sending out certain documents to you for your own personal study for the various other terminologies which are there in the books of accounts. So, having seen this, I would like to conclude today's class. We are ending quite early today, but I am willing to and open to take questions, whatever questions that you have. Let's utilize this time so that we finish this. I don't want to go ahead with other things because uh, we would like to start on a fresh note as we take on other things aspects. They would require substantial uh, time investment to explain, so we will take it up next time. So up to this point, if you are all clear on this, it will be great. And I'm inviting you to join me tomorrow 7:30 to 9:30 after the Glenmark issue is done. So if you have gone through that Zomato IPO video that I shared with you, we will be doing another one on Glenmark, because IPO analysis is a challenging task. So company provides you less information, you don't have too much time, right? And you need to prepare the questions, and we need to do the forecasting, and you have to be very careful with your numbers because you can go drastically wrong. So while we are doing that, what we will be doing is building into this over 2 parts. So tomorrow we will see the investment analysis part of it, understanding the RHP, the business, and all. And then on a class on Monday, we will be doing the financial forecasting. So it's going to be divided into 2 parts, and we will take it up, and it will serve as a very beautiful and live example of all the classes that we have done so far. Okay, how to get the data, from where do you get the data, how do you analyze the promoter, because in an IPO, is the promoter known to you? Of course, Glenmark is a known company, so you have got added confidence. But Glenmark, but apart from that, how do you study everything? How do you study in detail? What are the things to look at? Okay, so we will get into the depth of that. We will do industry analysis because it's a research company, it's a new area. We'll be studying all that, and from there, no. So at 4 p.m. tomorrow is the webinar organized by the company. So you can watch that. That is the link that I shared. And at 7:30 p.m. we will have our class webinar separately. So that webinar will be from 4 to 5, 5:30 max. Okay, and our class webinar will be from 7:30 onwards. It's the May batch. Okay, but I'm going to include you and all the ex students also, so that it's a nice breather refresher for everyone, and we can take it forward from there. Okay, so let's end this class today, and we will meet again tomorrow at 7:30. So John is asking, what is the self-sustainable growth rate from reinvestment? Basically, if you are not to, if you were to use your own funds to grow the business, how well you would grow and what kind of growth rate can you sustain. That is what is essentially the reinvestment thesis that you use for understanding that. Okay, guys, thank you so much for your time, and we will get on from tomorrow evening. Okay.